Inflation is back in the headlines, grabbing the attention of households and businesses across the UK. And it's hitting our wallets again, making everyday purchases feel noticeably more expensive than just a few months ago. The cost of living in the UK rose last month, with inflation climbing to 3.4% in December, up from 3.2% in November. That means prices for things like food, energy, and transport are rising faster than before, putting extra pressure on household budgets. While not as high as the double-digit peaks of recent years, this uptick is a setback for families hoping for relief. Many people were expecting inflation to keep falling, so this reversal is worrying for anyone trying to plan ahead or save money. Rising prices mean your money doesn't go as far, making everyday essentials and big financial decisions more challenging. Whether you're shopping for groceries, paying utility bills, or thinking about a holiday, you might find yourself having to make tougher choices. The Bank of England faces tough choices to keep prices stable, and their actions will affect everything from mortgages to savings. Interest rates, for example, could change, impacting how much you pay on loans or earn on your savings. In this chapter, we'll break down why prices jumped, what it means for your finances, and how you can respond. We'll look at the factors driving inflation and what experts say might happen next. Understanding these changes is the first step to protecting your budget. By staying informed, you can make smarter choices about spending, saving, and planning for the future. Let's dive in and make sense of what's happening and what you can do about it, so you can feel more confident navigating these uncertain times. Inflation is simply the rate at which prices for goods and services rise, affecting everything from your morning coffee to your monthly bills. It's a measure of how much more expensive things are becoming over time, and it impacts everyone, whether you're shopping for groceries, filling up your car, or paying for a haircut. As prices increase, the purchasing power of your money goes down. This means that each pound you have buys you a little less than it did before, making it harder to stretch your budget. Imagine a shopping basket filled with everyday essentials: bread, milk, fruit, and more. If the total cost of that basket goes up over time, that's inflation at work, quietly affecting your daily life. To keep track of these changes, the Consumer Price Index, or CPI, is used. The CPI measures the average change in prices paid by households for hundreds of different items and services across the UK, from food and clothing to transport and entertainment. When the CPI rises, it means your weekly shop, petrol for your car, and even everyday services like haircuts are costing more than they did before. It's a clear signal that the cost of living is increasing. The CPI is updated regularly to reflect real spending habits, so it's a true snapshot of the nation's cost of living. Market researchers constantly review what people are actually buying, ensuring the index stays relevant and accurate. For example, if the CPI shows a 3.4% increase, it means that, on average, prices are 3.4% higher than they were a year ago. This percentage helps everyone understand just how quickly prices are rising. This number isn't just a statistic. It influences everything from pensions and benefits to pay rises and business decisions. Governments, companies, and individuals all use the CPI to plan for the future and make important financial choices. So, if you feel your money isn't stretching as far as it used to, the CPI confirms you're not imagining it. Understanding inflation and the CPI helps you make sense of the changing prices all around you. In December, the UK's inflation rate ticked up to 3.4%, a figure that caught the attention of economists and households alike. This marks a reversal of the steady downward trend we'd been witnessing for several months, raising fresh concerns about the cost of living. Even though the increase may seem modest, it's enough to put renewed pressure on household budgets, especially for families already feeling the pinch. Between November and December, prices rose by 0.4%. This uptick followed a slight dip the previous month, suggesting that inflationary pressures remain persistent. Seasonal factors, such as increased holiday spending and higher demand for goods and services, certainly played a part in this rise. But beyond the festive season, the underlying issue is that the cost of living squeeze became even more pronounced as the year drew to a close. Core inflation, which strips out the more volatile prices of food and energy, held steady at 3.2%. This indicates that price pressures are not limited to just a few categories, but are widespread across the economy. While we're no longer facing the double-digit inflation peak of 11% seen in 2022, the current rate is still well above the Bank of England's 2% target, keeping policymakers on alert. The path back to stable prices is proving to be longer and more challenging than many had hoped, with bumps along the way. For now, the latest data serves as a clear reminder that the fight against inflation is far from over, and uncertainty remains. Both households and policymakers need to remain vigilant, adapting to changing economic conditions as they unfold. Next, let's break down the main factors driving these inflation numbers and see what's really behind the recent increase. December's price jump was driven by the end of November's sales and increased holiday demand. As Black Friday discounts faded, prices for goods and services rebounded. Festive spending on restaurants, entertainment, and travel pushed costs higher, especially in recreation and culture. Even small increases in essentials like food and transport added to the overall rise. These seasonal effects layered on top of ongoing supply chain and labor cost pressures, keeping inflation stubborn. Rising inflation hits hardest at the checkout and on your monthly bills. A 3.4% increase means your $100 shop now costs $103.40, small changes that add up fast. Essential bills like council tax and utilities often rise with inflation, squeezing budgets further. Savings lose value if interest rates don't keep up, eroding your hard-earned money over time. For many, this means cutting back, switching brands, or delaying big purchases. The psychological toll is real. Uncertainty about future costs can cause stress and anxiety. Managing your money becomes a daily challenge. This isn't just a statistic, it's a reality for households across the country. The Bank of England's main job is to keep inflation at 2%, a level that balances growth and stability. With inflation at 3.4%, we're still far from that goal. The bank's main tool is the base interest rate, raising it to cool inflation, lowering it to boost growth. Recent hopes for a rate cut have faded with this latest inflation jump. High rates mean borrowing stays expensive, affecting mortgages and loans. The bank will likely hold off on cuts until inflation shows a clear, sustained drop. For now, expect the higher interest rate environment to continue. Stability remains the priority, even if it means short-term pain. High interest rates directly impact anyone with a mortgage or loan. For those on variable or tracker mortgages, monthly payments remain high as long as the bank rate stays up. Fixed-rate deals offer short-term protection, but many will expire in 2026, forcing homeowners to remortgage at higher rates. Hopes for cheaper deals have dimmed with the latest inflation data. Personal loans, car finance, and credit cards are also more expensive, making borrowing tougher for families. The era of cheap credit isn't returning soon. If your fixed-rate deal ends soon, start planning now. Speak to an advisor and budget for higher payments. For those on variable rates, keep budgeting for current costs. Patience and preparation are key as we wait for relief. Economists expect December's inflation rise to be temporary, with prices likely to ease in early 2026. Falling energy bills, thanks to a lower price cap, could help bring inflation closer to the 2% target by April. If this happens, the Bank of England may start cutting rates, offering relief to borrowers. But risks remain. Global conflicts, supply disruptions, and rising wages could keep inflation higher for longer. The bank will wait for several months of steady data before making any moves. The next few inflation reports will be crucial in shaping the outlook. While the long-term trend is downward, the pace is uncertain. Households should stay alert and flexible as the situation evolves. Rising prices are tough, but you can take control. Start with a detailed budget, track every expense and look for savings. Use budgeting apps, cut unused subscriptions, and compare deals on bills. Plan meals and switch to own brand products to save on groceries. Move savings to higher interest accounts or fixed-rate bonds to protect their value. If you have debt, consider consolidating or transferring to lower interest options. Don't hesitate to seek help. Organizations like Citizens Advice and Step Change offer free, confidential support. Taking action now can make a real difference, even in challenging times.